At this time, I would like to introduce our second speaker of the day, Dr. Todd Kuethe. Dr. Kuethe joins us today from Purdue University, where he serves as Associate Professor and Schrader Endowed Chair in Farmland Economics. He previously served as Clinical Assistant Professor of Land Economics at the University of Illinois. Dr. Kuethe helps policymakers, farmers, and landowners make better decisions to ensure a safer, more flexible, and more sustainable agriculture economy. Todd's research interests are focused on farm real estate markets, agriculture credit, and agriculture policy. He has published more than 30 scholarly articles in leading field journals such as the Journal of Agriculture Economics and Land Economics, and is also a regular contributor to the University of Illinois' Farm Doc Daily. Prior to joining the University of Illinois, Todd spent several years as an economist with the USDA Economic Research Service, where he contributed to a number of USDA reports on farm real estate markets and agriculture policy. Todd earned a PhD in agriculture economics from Purdue University, a master's in agribusiness economics from Southern Illinois University, and a bachelor's in economics from the Richard A. Chaffetz School of Business at St. Louis University. Outside of academia, Todd spends his free time with his wife, Catherine, and their two children, Margaret and August. The family enjoys hiking, fly fishing, and camping in their Volkswagen camper van. Most importantly, they are Purdue basketball fans and look forward to hearing their children yell "Boiler up" at sporting events. However, we won't hold that against him today here in Buckeye Land. Thanks for being with us, Dr. Kuethe. And at this time, I'll turn the program over to you.
Thank you. I'm trying to get my slides set up. There we go. Do you guys see them? All right. So thank you, Ben. Thank you, everybody, for having me today. Really excited to give this talk. A little bit bummed that I don't get to join you in Columbus, but hopefully in the future when things get back to normal. So I'm going to talk to you a little bit about farmland market outlook, generally speaking. This actually, I might be a little bit rusty and I can't see your faces, so I can't tell who's falling asleep or is getting bored like I usually can. But the last thing I did before we went on the coronavirus break last spring was to give a farmland market talk, and I haven't given one since then. So hopefully I'm not too rusty. But anyway, so I work at the Department of Agricultural Economics here at Purdue. We have a new position, the Schrader Chair in Farmland Economics, which I have the good fortune of being the first person to fill it. But I basically run a intertwined program of research and extension related to farmland markets. And so I'll talk to you a little bit about sort of farmland markets generally, and then give you some of my outlook sort of going forward, both in the near term and long term in terms of what we expect for farmland market. It's probably not surprised, in between sort of Ani's talk and Courtney's talk, farmland is sort of where farm incomes and financing sort of meet together. Let me see. There we go. So here in Indiana, obviously, for those of you who visited the state, farmland is a big part of our natural land cover and a big part of our ag economy. So the map I show here, the gold areas are those cultivated in crops, and the black area in pasture. So any place that's white is either urban land use like we have in Indianapolis or up around Chicago, or in the southern part of the state is a lot of natural resource use. So we have a lot of forestry, a little bit of mining and extraction, but just basically land that's not suitable for agricultural production. But here in Indiana, we have about 15 million acres of agricultural land. It's worth a cumulative about $60 billion. And so the average farm here in Indiana holds about $1.7 million in their investment space. And so it's a really critical part of the farm economy, as most of you watching will know. Similar to the rest of the Corn Belt, we have about 80% or 82% of the value of all the assets in the farm sector concentrated in farmland. And farmland also makes up about half of our total debt, or in mortgage payments for farmland or mortgage debt. So it's part of what keeps that debt to asset ratio pretty low for the sector. So here in the Corn Belt, we've seen a little bit of uptick in debt to asset ratios, but we still stay relatively low. And a big part of that is because of the farmland being a huge part of our assets and sort of a middle section of our debt. It's helped keep the long-term solvency of the sector very robust. So even in cases where we've had recent years of declining incomes or tight operating margins, absent of government payments, land values have really helped provide that security to our farm sector. And so this map here, or this figure, this is from the USDA. Every year in August or September releases a land value report for across the entire country. I've pulled out here just what USDA defines as the Corn Belt states, and in black and in gold, and the more bold ones are Indiana and Ohio. Indiana being the black one, and Ohio being the thick gold line. And so you can see we both sort of hang in the middle of the Corn Belt. Recent years below what we've seen in Iowa and Illinois, but far above what my home state of Missouri, they're hanging in at the bottom of the Corn Belt, although only about half of Missouri is really Corn Belt agriculture, the bad half. But anyway, and so we've seen, a sort of general trajectory in farmland prices across the Corn Belt, where we had sort of modest gains after the rise and fall in the 70s and 80s, up till about the renewable fuel standards and the commodity price boom of the mid 2000s, where farmland prices really shot up pretty aggressively. And then since about 2014, prices have moderated around the Corn Belt. Now, we didn't have in Indiana, we didn't have quite the rise that we had in the Western Corn Belt and in Iowa and Illinois, but we also haven't come down quite as much. So you can see over the last couple of years, it's relatively plateaued. We're in kind of a holding position, where Ohio, which didn't experience as rapid of gains, has been just sort of modestly increasing over the last several years. But that gives you some context, sort of my experience here in Indiana relative to what farmers are seeing in Ohio, or farmland owners seeing in Ohio. So when I think about the outlook of farmland prices, or what do we expect farmland prices to be, there's this old adage that economists frequently quote, that all models are wrong, but some are useful. And so a really simple model we use to understand farmland values is that net present value. And so if you think back to your introduction to economics, introduction to finance classes, by owning farmland, what we get is essentially a ticket to get any of the value that accrues from owning farmland over time. And then we want to discount those returns over time. So we as all consumers and investors, we have a natural preference to want to have money now than in the future. So I always harp on my undergraduate students, the four main reasons are: one, we don't know if the future is going to happen for us. The future is uncertain. Two, we are impatient consumers. So we want money now, because if we're going to buy anything, we'd rather buy it now than in the future. So I'm somebody that's already thinking about things for Christmas, and I see something that I want for myself and I buy it now, right? Or we can invest it in other options. Or then the fourth is inflation, which is, as you can understand, getting harder for students to be sympathetic to, given the very low interest rates we've experienced in this country over the last couple decades. So I pause here because I'm going to show you what I just told you, but in an equation form. And I know for those of you watching at home or in your office or where you are, you may not be ready for math in the middle of the day, but here we go. So it's just that very simple model where we have that present value, or the value of farmland, so P, that's the price of farmland, is function of our expected return. So that's the E sub R, that's our expected earnings we'll get from owning farmland over the life of the horizon of the investment. And since farmland is something that we can hold forever, there's very little depreciation. We tend to look at sort of infinite horizon type problems, but we discount those returns by a function of I, which is our cost of capital, or our discount rate. So this is how much we want to discount, or how much credit we want to, or how much we want to trust the future as being something we realize versus what our preference is for now, right? So, I often talk about with my students, like when I was younger and I would borrow money from my dad, I had a very high discount rate because he didn't trust me that I was actually going to pay him back, right? So he would only loan me very small amounts of money, or would say, well, you got to really, promise and deliver through. So he has a very high discount rate. He didn't trust the future when he was loaning to a teenage son. But we can offset a little bit of that discounting by some projected growth of the earnings, right? So we can have that sort of growth. So when I give outlook talks around the state and around the Corn Belt, I almost always have someone come to me and say, well, did you see about this sale that just occurred in whatever county? And they always say, well, the price was way too high. Like, I've looked at this, I've tried to pencil it out myself, and I just can't understand how they justify it. And really, a lot of that comes down to how we make these choices in the elements of that present value function. So here, I'm just going to assume a pretty conservative growth rate of 1%. So say we're going to have our earnings continue to grow at a 1%. But then we'll change what we think about those expected returns. So just think about this as like a cash rental rate. So if we have land that we can observe the cash rental rate somewhere between $200 to $400, But then we have different ways we want to discount those, and that can justify very different projected returns based on our projected price for that land based on how we feel about the discount rate. So if you look at a $200 cash rented land, we can justify anywhere between $10,000 to $4,000 for paying for that based on how we're willing to accept the discount rate. So that's often where a lot of the difference comes in. So when I start thinking about the future of farmland or some outlook, those are basically the three parts I look at: is what is the return from farmland? What can we expect for returns? How do we discount any future returns? And then also, what is the potential growth for those returns over the future? So how much can we continue to expect those to increase over time? So I'll go through those, some indicators I look there quickly. As Ani mentioned, the farm income forecast from the USDA. So I want to kind of remind again, this is the black is the observed national level. Again, keep in mind, this is for the entire United States. So we're looking at a lot of regions around the country, a lot of different commodities. So we can have places where some commodities or regions are relatively prosperous and some that are financially challenged quite a bit. But just overall, what's the big broad picture in terms of growth of our current condition of farm income? And we can see that we have been increasing since about 2016. Also, as Ani mentioned, these early forecasts tend to be below. So you can see a lot of those dots of the various forecasts that come out tend to be below that black line. So there's actually some belief that we could see even higher incomes than what USDA is actually projecting, was projecting as of September. But we're getting close to, I think, pretty good read on what the number will be at the end. But there is some evidence there that incomes are being supported pretty much. Now, a lot of that again is coming from government payments, things like the MFP or the CARES Act or Paycheck Protection Program, and there's Congress is getting ready to debate right now a coronavirus stimulus package that I'm sure agriculture and food sector will be a big part of that conversation. So a very cynical take is that income should be much lower and these government payments are going to go away and then the bottom is going to fall out. A very optimistic take says, well, actually we're going to, the reason we have these temporary payments is because our markets are being disrupted and we're going to get back to those markets and we're going to get back to that income. And so there's again a place where it's sort of a matter of opinion and sort of how much people are willing to track. But the way I tend to actually think about the income from farmland is to look at cash rental rates. It's sort of the great sort of information aggregator, and we're getting people that are putting real money on the line, right? So how much they think land is willing to rent. Now, the other thing is cash rent is one of the hardest things for economists to measure in the ag finance sphere. Farmers tend to work with multiple landlords. I always say if you get tired of hearing a farmer talk, you should ask what they're paying in cash rents because they don't want other farmers to know because they don't want to increase competition. They don't want other landlords to know in case they're paying different amounts to different landlords. So it's relatively tough to measure, but we do a survey here in Indiana every June looking at cash rent and land value around the state. So this actually comes from, this is a state level average we ask about 3 qualities of land: high, average, and low. And that's based on long run corn yield potential. And you can see over the last several years, we've had cash rental rates that were started declining sort of around 2014. And then again, similar to land values, have sort of plateaued. And just this last year in 2020, we did see an uptick from 2019. But again, a lot of that, that was tough for a lot of farmers to hear in June, but they made those rental agreements last winter. And so the outlook for this year, I think, there's cash rent probably more likely to sort of hold steady. But if we look at looking at that formula again, if we just divide cash rent by a 10-year treasury, that gives you some idea of what economists would call sort of the fundamental value or the potential value of that farmland. So I was born in 1981, something I have to remind a lot of farm audiences when I just talk about the 1980s, but you can see here in the 1980s where that dashed line is the observed land value and the black is that sort of capitalized rental rate. And you can see where the land value was much above what the capitalized rent would say, which is economists' definition of a bubble, right? So we had a case where the prices were getting bid above what the current income and discount rates would imply, the earning potential. Now, fast forward to the more recent years, we've seen an uptick and then a decline in land values. And again, we see these this capitalized value well above, which means although land prices are high in a lot of areas, there's some way we could justify it being a little bit higher. Now, we do have to think that, you know, those incomes and interest rates are going to be permanent. I think that's why we're not seeing land values get bid up quite as high. But, you know, the cash rental rate also is a big part of the income that a lot of farmers and farmland owners, when they think about land values, they just think about that appreciation rate. So how much of the price is changing year to year? That's shown here by this silver bar, where the gold bars are the total rent. So you add those together to get that total return in land values. So we have cases where, you know, the appreciation is falling. We see land values falling in the 1980s and again around 2014. But with that positive appreciation, we had some years where it was able to sort of sustain farmland owners, if they are able to stay patient, can kind of wait that out. And that's why we have that sort of really good solvency position across the sector. So the next thing is, so how do we discount those rates? So a lot of economists will talk to you about the Fed, and people ask about, you know, what's the Fed going to do and how's that going to affect land values? I'm under the opinion that the Federal Reserve short run interest rates don't have a huge impact on land values. And so this is the graph I sort of used to argue that. So when we think about really the cost of borrowing and mortgage debt as really the measure of how do we capitalize that income into coming up justifying a land value. So this bottom rate is the federal funds prime rate. So this is what the Federal Open Market Committee, the Federal Reserve, sets that discount rate, the overnight borrowing at Fed institutions to qualified lenders. And that is the bottom bar. So we can see that we have seen an uptick in interest rates since about 2015. We've now seen them fall again. I haven't been able to update the data here in the slide, but then the next jump up is actually the prime rate. So this is what businesses charge, or banks charge their best borrowers. And so since about the 1990s, it's about a 3% increase. That's just the cost of them doing business. And the black line at the top is the farm mortgage rate. So this is coming from the Chicago Fed, which covers all of Iowa, the northern 2/3 of Illinois and Indiana, the lower peninsula of Michigan, and the small and southern Wisconsin. So it sort of captures a lot of the Corn Belt. And we can see that here interest rates have gone up for mortgage rates, but not at the same rate that we have in terms of the increase of the Fed funds rate. And in fact, a lot of times we see you know, the mortgage rate, the difference between that prime rate and the farm mortgage rate has to do with what's the risk in the ag sector relative to the broader economy. And so the other one is, you know, so we think about, so argue we want to look at the long end of the yield curve. What that means is essentially we want to look at the costs of borrowing at the long end of those borrowing relationships. And so this is what, you know, economists talk about the yield rate, the yield curve being that, you know, if we have an equal risk investment, we will pay a higher interest rate the longer you let us hold that money. And it usually looks like this. And so this is going to be a little bit tricky. So I put this break in here. It's going to look a little bit like spaghetti, but I'm going to show you every yield curve we've had per month going back to 2001. And that's what this looks like. That's what those gold lines are. And the black line is what the current yield curve looks like. So you can see in most years, we have that sort of pattern we'd expect in terms of the increasing interest rate over time. And then we've had a few years where we have like a bit of an inversion, which I'll tell you a little bit here why that's concerning. But you know, this summer the yield curve really flattened out. We had, you know, we cut low interest rates at the short term to very, very low, as low as we could get them. And also the long end of the yield curve also was very low. People were concerned about long run and how deep is a recession going to be? What's COVID going to do to the economy? Over the last couple of months, we've seen some movement upward on this long run into the yield curve. And this is important because this is how lenders make money, is based on the shape of that yield curve, right? So they're playing across the various horizons. So they're taking short-term deposits, bundling those up, giving those someone out to a long run loan. And it's just that difference in time is where lenders make money. So as that yield curve flattens, it gets much more difficult to make money. When it inverts, it's actually riskier to loan long term, much riskier than it is to have short run. And so we see people sort of stop lending at the long run of the yield curve, which tends to bring in recessions. And that's what this shows here. But you can see, so when we think about the mortgage rate, farm mortgage rate. We also talk a lot about the 10-year security, 10-year treasury. And that's because they held a relatively constant spread between those two securities for a long time. So that 10-year treasury is really where I look to see sort of what's the action in the 10-year treasury and how does that tell us about land values going forward. So then the last little bit here, I'll talk to you about sort of where I see the income growth potential in terms of justifying farmland price changes. So the easiest way to make money when you own farmland is to develop it for other uses, right? So it's the easiest way to have like a big paycheck with land. And so everywhere I've gone in the country, somebody always talks about, some landowner in their county that's buying up every bit of farmland and wanting to develop it. And that really drives it. So this is sort of the economic model that justifies economists use to think about that premium. So if you think about, if you're in downtown Columbus or Cleveland or Cincinnati, you're right in the heart of downtown. That's all the way to the left on this axis. And land values there per acre are the highest you'll find. And a lot of that has to do with the value of accessibility to all those urban infrastructures, urban land use. And then as you drive or walk out of the downtown and move towards the countryside, the value of accessibility starts to decline. And so you start to see different land use. So you start to see, smaller buildings. We start transitioning from multi-family unit housing to single family housing. And a lot has to do with just that value accessibility. Yards get bigger, houses get bigger. And a lot has to do with that sort of per acre value. And then at some point, we start to move away from land use that's driven by urban accessibility. And it's just what's the growth of potential income. And so as you get to the countryside, you'll see farmland that gets sort of bid up over time that way. And so here in our survey we do in Indiana, we also ask about land transitioning out of agriculture. So that's the gold bar here, which you can see is a much higher price per acre than we see for even the top quality of land production. So if we convert that transition premium into that difference between the transition and the top land values as sort of a conversion premium or development premium, that gives us this gold bar, which you can see for a very long time here in Indiana. Land that was sold to conversion was basically twice as valuable as land that was held in agricultural production. And a lot of that was correlated with housing starts and development. And then as we've seen the housing development premiums, or housing starts collapse starting in about 2005, we saw a huge decline in that premium. And now we're just starting to see an uptick in housing starts again, but not quite enough to pull it up to that sort of long run level. So at least here in Indiana, I don't think development premium is going to be a big driver. I look more at the ag potential. So here, just a couple quick slides about the potential growth in farm incomes. So this is the share of the world's population related to their real GDP per capita. So here in the United States, we're very fortunate because we have very high GDP, very high incomes, and we have a lot of people. So we have a very big bar there all the way out to the right. And if you look at our historic trading partners, places like Japan and Russia, Mexico, Canada, they have relatively high incomes and sort of modest populations. And then if you look over the more recent years, the reason we've seen growth in places like China, and I think India will be another major player, is because they have low incomes, but they have a whole lot of people. So you can grow that bar in two ways. You can add people, keeping the same income growth, or you can really increase the income. So just a small change in income really affects the consumption for ag commodities. I'll show you here. So this is the relationship for GDP per capita and meat consumption. So if I think about my own life, as a college student, I mostly ate hot dogs and canned tuna. And then I go to graduate school and I start eating sandwiches and hamburgers. And then I get, now that I'm a professor, I eat steaks and chicken and fish. So my consumption of proteins from meat has gone up. And so what that means is that has impacts throughout the whole supply chain, right? Because we have to feed those things income. So we go from feeding rice to fish to then feeding hogs, and then anyway. So here in the Corn Belt, we are blessed with some of the best soil quality, ag suitability in the entire world in terms of soil quality, weather. So this actually comes from the University of Wisconsin, and they look at basically agronomic potential. So we have a huge advantage here in the Corn Belt because we can produce commodities very well. We're also very close, Ohio especially, to a lot of major markets. We have a lot of consumers here, but we also have high access to the world market. So, if you think about long-run growth potential in the demand for commodities, places like the Corn Belt are well suited to participate and benefit from that. And then finally, last one, really quickly, but a lot of folks have pushed for, you can't go to an ag meeting these days. People talking about ag technology and the change in the future, what's going to happen. So these are all the different sort of startups that look at ag production and trying to use big data or technology to address the needs of farm and food production and address sort of every issue. I don't think all of these are going to be the big winners, but it only takes one or two to really drive a change in terms of bringing down the cost of production or increasing the ability to translate what consumers are demanding into the farm gate. And so I think, so the quick wrap up, I believe that farmland, the outlook for farmland is really good the longer you go into the future. I think it's going to continue to be an asset that creates growth and wealth for the farm sector. Going into the next year or so, it'll be really interesting with coronavirus. I don't think we'll see quite as much sales going on to the market. That lower transaction volumes have really helped prices stay up the last couple of years. There's a lot more optimism coming in about incomes into the future. So at least keeping cash rents sort of where they are now. And I think we're going to see as long as the coronavirus uncertainty is out there, we're going to continue to see low rates of borrowing or low interest rates and charges. So that's all I've got, Ben.
Thank you. Appreciate it. And always really enjoy all the information you share. And thanks for being with us. If you wouldn't mind sticking around, we'll see if we have any questions for you at the end. But we do want to